Hi folks, welcome to another episode of Who Said What. I'm your host Krishna, and for those of you who are new here, let me quickly set up some context for what this show is about. See, the idea is that I'll pick the most interesting and juiciest comments from business leaders, fund managers and the likes and contextualize things around them. Now, some of these names might not be familiar, but trust me, they're influential people and what they say matters a lot because of their experience and background. So I'll make sure to bring a mix. Some names you'll know, some you will discover, and hopefully it will give you a wide and useful perspective. With that out of the way, let me get started. See, quick commerce in India is no longer a question of whether it will scale. It's a question of who will own it or at least a significant part of it. See, in one corner you have got Blinkit, who's the market leader, moving fast and building for speed. In the other, the mammoth Reliance, armed with 19,000 plus stores, strong offline network and a balance sheet big enough to swallow entire categories. One has operational finesse, the other overwhelming might. Let's start with Reliance. In one of their recent earnings call, the company made a forceful case that it's uniquely positioned to win this game. Not because it's nailed the 10-minute model, but because it has the widest and deepest physical footprint in the country. Here's what they said on the earning call.
We are already present in 1,000 cities. Most of the cities where we are doing quick commerce today, they will possibly not reach there in the next 3 years as well. Why should I give up that advantage? I will continue to leverage my store network. Wherever there are gaps, wherever I need to reduce the delivery radius, or wherever there is enough order volume, we are going and setting up dark stores.
That's Reliance telling the market, you may win Delhi or Bangalore, but we already own India. And they're backing it up with numbers. 2,000 of their 19,000 stores are now tied into their quick commerce network, reaching over 4,000 pin codes. Here's what they said on their recent earning call.
We have almost 2,000 plus stores which are on the network, covering more than 4,000 plus pin codes. So this is much wider reach than any other quick commerce player. We have kind of repivoted our model completely to under 30 minutes delivery.
See, there's a tone of inevitability in the way Reliance speaks about this market, like it's already theirs, as if scale alone is a moat. But what if scale isn't the moat they think it is? See, here's where things start to break. The quick commerce model isn't about physical proximity. It's about operational choreography. It's about how quickly a picker can locate, grab, and hand over an order. It's about store design, product packaging, and SKU layout. It's not retail, it's fulfillment. Now, Reliance is trying to do quick commerce by bending its existing store network into this shape. But I spoke to a journalist who closely tracks this space, and she pointed out that this might just be structurally flawed. Reliance's store layout is fundamentally different from a dark store. That difference is everything. See, Blinkit is built to pick, pack and dispatch in 60 to 90 seconds. Reliance at the moment isn't. If Reliance is leaning on scale and cash, Blinkit is leaning into precision. In their recent quarter, they took their total dark store count to 1,500. And now they are on track to hit 2,000 by the end of the year. Albinder, the CEO of Blinkit, said this in their recent shareholders letter. The opportunity in front of us is massive, which means that the competition in this space is also very high. Under no circumstances will we let go of our market position here. Blinkit's confidence comes from its operating system. This isn't a company simply rolling out stores. It's building a tightly integrated logistics, warehousing, inventory and retail stack, all engineered for one thing, which is speed. Now at its core, this is the real contrast. Reliance has money, Blinkit has mastery. Reliance has more capital, more locations and more corporate heft. Blinkit has faster iteration, better design and a single obsession. Get to your door in under 10 minutes. Reliance is repurposing its stores to do more. Blinkit is building from scratch to do one thing well. Now the question remains, who will win this? Earlier this week, in an interview, Samir Arora, the fund manager of Helios Capital, had some very harsh things to say about a sector which has been India's shining light for a very long time, which is IT. He has just one IT company in his portfolio.
And basically, IT sector itself has been disrupted. What to say? IT sector itself is disrupted right now. People don't want to believe it's been disrupted black and white. You can see it in every result, every company.
It's a bold statement, almost as if to say that IT companies are well into the process of being rendered obsolete forever unless they change themselves. It wasn't that long ago in the pandemic, IT stocks made lots of people wealthier. What changed in those 4 years? Well, let me first take a look at what hasn't changed. We have covered this extensively in the stories on Indian IT. We'll link it here. The dominant business model of a large IT companies is exporting low-end technology services to developed nations based on lower labor costs. It has been excessively dependent on all three elements: the type of service, specific regions, and low wages. Between 1999 to 2013, IT's share of patents compared to other sectors was at a dismal 2%. They've been spending a minuscule share of their revenue on R&D to move to higher value activities while getting strong cash flows from its rich clients. See, that extra cash goes mostly either as dividends or saved up for a rainy day as retained earnings. This staticness is under multiple threats today. Firstly, AI. While Indian IT companies are working to bridge this gap, most of their AI experiments are still in the proof of concept stage. Their AI services business haven't taken off yet. They will also need to upskill most of their workforce on Gen AI, a humongous task by any measure. On the other hand, startups and mid-sized firms are shifting their focus to AI faster. Secondly, the rise of global capability centers or GCCs in India. See, GCCs are hubs set up by foreign firms for outsourcing certain tasks to India, and our IT firms were key to welcoming them. Today, however, GCCs are eating into Indian IT's lunch by poaching their employees with better wages. More importantly, they offer more than low-end services, which translates to better work and better pay. Meanwhile, attrition is really high in our IT firms. Lastly, US tariffs. When the country that we have sold the most to starts putting a tariff on our services, we will cease to be cost competitive. While this hasn't happened yet, it is changing how our clients think, creating lots of uncertainty in the supply chain. IT continues to be one of our strongest exports today and is expected to grow in the near future. But the growth rate is slowing. Our large cap companies need a makeover, and they know it too. This is also an effective teaser for the Daily Briefs roundup of the IT sector's results, which is coming soon. Someone that we know loves throwing quotables is, of course, US President Donald Trump. And yet again, he has said something almost unbelievable. At a national AI summit, he revealed that he had considered breaking up what is probably the most powerful American company today, NVIDIA. But he figured that it would be extremely hard to do so.
I figured we could go in and we could sort of break them up a little bit, get them a little competition. And I found out it's not easy in that business.
Now it's true that NVIDIA virtually owns the market for high-end AI chips, estimated to have more than 70% market share. That has attracted anti-monopoly investigations on it, not just in the US but also China and Europe. The main allegation is that NVIDIA is cutting out competition and reducing choices for customers through unfair means, which include A. Making its products not interoperable. Only NVIDIA chips and no other can work with NVIDIA's software, which is CUDA, therefore making it very hard to switch for customers. B. Pressurizing customers to buy bundles with deals like you'll only get X at a steep discount if you buy Y, or offering different prices to those who use competitors' products. C. Startup acquisitions. But some of these things aren't black and white, meaning that this may not be the result of a deliberate attempt by NVIDIA to discourage competition. So it's hard to prove that they were ill-intentioned. For example, was CUDA really built with the intention to exclude competitors? Maybe it was a function of design and compatibility. In fact, NVIDIA chips also work with AMD software OpenCL, though not as efficiently. The court has to prove if NVIDIA is externally penalizing the use of competitors' cards. With bundles, many companies give discounts when you buy their products in bulk. What needs to be shown is if the discounts were excessively discriminatory along with customer complaints about product quality. See, acquisitions are also not inherently bad by themselves, especially if they improve a product. Are these acquisitions simply done to later shut them down? After the acquisition, did their compatibility with competitors' products worsen, and how? See, one fact makes all of this harder to prove. NVIDIA's AI chips are better than the rest. NVIDIA's Blackwell GPU has outperformed every other when it comes to benchmarking AI performance. They also work far better with CUDA in comparison to any other software. NVIDIA's strength hasn't been written in stone. In the 2000s, for non-AI consumer use GPUs, it has often been neck and neck with AMD, sometimes even being behind. All PlayStations and Xboxes run on AMD chips. But AI chips look to be different ballgame, and it will be difficult to differentiate between how much of NVIDIA's dominance in this sector is due to being unfair and how much due to being smart, early, and better than everyone else. That's it for this episode. If you have any feedback for me, please let me know in the comments below. Hi folks, welcome to another episode of Who Said because sorry. Said that this might just be structurally flawed. When the country that we have sold to, now who will win this?
Now the question remains, who will win this? Now who will win this? Now who will win? Now who will win this? We'll found now who.
Secondly,
The rise of global capability.